People often ask me what I think about Michael Burry. They want to know if I follow his trades, if I pay attention to his predictions, if I think he is a genius or a madman. And I have to tell you, the question itself reveals something important about how most people misunderstand investing. You see, Michael Burry and I could not be more different in how we approach markets. We have completely different philosophies, completely different time horizons, completely different definitions of what success even means. And yet, we have both made fortunes in the stock market. We have both been proven right when everyone else thought we were wrong. We have both earned reputations as two of the most successful investors of our respective generations. So how can two people with such radically different approaches both succeed? That question gets to the heart of something I have spent 70 years trying to understand about investing, about markets, and about human nature itself. And today, I want to share with you exactly how I think about this, because understanding the answer might be the most important investment lesson you ever learn. Let me start by telling you a story about a time when I was absolutely certain I was right, and the market was wrong, and the stock market was in free fall. The nifty 50 stocks that everyone had loved just a few years earlier were collapsing. Polaroid dropped from over $140 to $14. Avon fell 90%. The market as a whole declined nearly 50% over the next 2 years. And I was buying. I was buying everything I could get my hands on. Not because I predicted the crash, but because the prices had finally reached levels that made sense to me. I remember telling my partners at the time that I felt like an oversexed guy in a harem. There were opportunities everywhere. Now, during that same period, there were plenty of smart investors who were predicting further disaster. They were certain the market would fall another 50%. They were selling everything, moving to cash, waiting for the final capitulation. Some of them were right in the short term. The market did fall further before it recovered. But here is the thing. I do not know anyone from that era who successfully timed both the exit and the re-entry. The people who sold and waited for the bottom mostly missed the recovery. They were waiting for a clarity that never came. By the time they felt comfortable buying again, prices had already doubled or tripled from the lows. This experience taught me something fundamental about my own limitations and about the nature of market timing. I cannot predict what the market will do tomorrow or next month or next year. Nobody can. But I can evaluate whether a business is worth more than its current price. I can assess competitive advantages, management quality, and long-term earnings power. And when I find businesses trading at significant discounts to their intrinsic value, I buy them. I do not worry about whether they will go lower first. I do not try to time the exact bottom. I simply buy when the price is right and then wait. Sometimes I wait years. Sometimes I wait decades. But eventually, the market recognizes the value, and I am rewarded for my patience. Michael Burry operates completely differently. He tries to identify specific mispricings in the market, and then makes concentrated bets that those mispricings will correct. His famous trade against subprime mortgages in 2005 through 2007 is the perfect example. He analyzed the underlying mortgages, realized they were garbage, and bet billions of dollars that they would default. He was early. He was very early. For nearly 2 years, his positions showed massive losses. His investors were furious. His brokers were demanding more collateral. Everyone thought he had lost his mind, and then he was spectacularly, historically right. The mortgages defaulted exactly as he predicted, and he made hundreds of millions of dollars for himself and his investors. That trade was brilliant. I have enormous respect for the analysis he did and the conviction he showed, but I could never make that trade. not because I lack the analytical ability, but because I lack the temperament. Sitting through 2 years of losses while everyone tells you that you are wrong requires a specific kind of psychological constitution that I simply do not have. I would have lost sleep. I would have second-guessed myself. I would have probably closed the position before the payoff came. This is what I mean when I say that different approaches work for different people. Burry's approach works for Burry because he has the psychology to handle it. My approach works for me because I have the psychology to handle long holding periods and market volatility without panicking. Neither approach is objectively better. They are different tools suited for different craftsmen. The key is to understand yourself well enough to know which approach fits your temperament. Most investors fail not because they pick the wrong approach, but because they pick an approach that does not match their psychology and then abandon it at exactly the wrong moment. Let me tell you about the portfolios themselves, because the differences are striking. My portfolio at Berkshire Hathaway is concentrated in a relatively small number of large, stable businesses that I intend to hold essentially forever. Apple represents a massive position. We own significant stakes in Bank of America, American Express, Coca-Cola, and Chevron. These are not exciting companies in the sense that they are unlikely to double or triple overnight. They are boring, predictable, cash-generating machines that will likely be around and profitable for decades to come. I buy them, and then I do nothing. I collect dividends. I watch the businesses compound their earnings year after year. I occasionally add to positions when prices become attractive, but mostly I just sit there. Charlie Munger used to say that the big money is not in the buying and selling but in the waiting. He was right. My best returns have come from positions I held for 20 or 30 years, not from clever trading. Burry's portfolio looks completely different. He is constantly adjusting his positions based on his current view of the market. He might be long certain stocks one quarter and short the market the next. His 13F filings, the quarterly reports that hedge funds must submit to regulators, show significant turnover. He bought and sold GameStop. He has had positions in water rights, farmland, gold, and various commodities. He has used options and other derivatives to express views about market direction. His portfolio is a reflection of his current thesis about what is mispriced in the market. When that thesis changes, his portfolio changes. This approach can generate spectacular returns when he is right, but it also requires being right repeatedly. Each trade is a new bet that has to work out. There is no compounding of a core position over decades. There is a series of individual bets, each of which must be evaluated on its own merits. I want to be clear that I am not criticizing Burry's approach. It works for him. He has made enormous amounts of money. He has one of the most impressive track records in hedge fund history when you account for the size of his fund and the concentrated nature of his bets. But it is a fundamentally different game than what I play. I play the game of finding great businesses and partnering with them for decades. He plays the game of finding mispricings and exploiting them before they correct. Both games can be profitable. They just require different skills and different temperaments. Here is something that might surprise you. I actually think Burry and I agree on more than people realize. We both believe that markets are often irrational. We both believe that careful analysis can reveal mispricings that the crowd is missing. We both believe that independent thinking is essential to investment success. We both believe that you should only invest in things you understand deeply. Where we differ is in what we do with those insights. When I find a mispricing, I tend to buy and hold, trusting that time will vindicate my analysis. When Burry finds a mispricing, he constructs a specific trade designed to profit when that mispricing corrects, often using derivatives or other instruments to maximize his return. Both responses to the same insight are valid. They just express different philosophies about time, risk, and the nature of markets. Let me talk about something that I think is crucial to understanding why both approaches can work, and that is the difference between being right and making money. These are not the same thing. You can be completely right about your analysis and still lose money if your timing is off, or if you cannot hold your position long enough for the market to agree with you. You can be wrong about your analysis and still make money if you get lucky or if other factors move in your favor. Investing is not a game of pure logic. It is a game played in the real world where psychology, liquidity, and time all matter enormously. Burry was right about subprime mortgages, but he almost did not survive long enough to collect on that correctness. His investors were withdrawing money. His counterparties were demanding more collateral. If the timing had been slightly different, if the crisis had taken another 6 months to unfold, he might have been forced to close his positions at a loss, despite being fundamentally correct about the underlying analysis. This is the risk of making highly concentrated, time-sensitive bets. You have to be right, and you have to be right within a specific time frame, and you have to survive until your correctness is recognized. My approach has a different risk profile. When I buy a great business at a reasonable price, I do not need to be right about timing at all. I do not care if the stock goes down 30% next year as long as the underlying business continues to perform well. I have the luxury of time because I am not using leverage. I am not making bets that expire, and I have permanent capital that cannot be withdrawn by impatient investors. This gives me the ability to be wrong for years and still ultimately make money. Some of my best investments looked terrible for extended periods before they worked out. The Washington Post was underwater for years after I bought it. Coca-Cola had significant drawdowns. American Express nearly went bankrupt in the 1960s before becoming one of my best ever investments. I could hold through all of that volatility because my structure allowed me to, and because my psychology allowed me to. Now, let me address something that I know many people are wondering about. What do I think about Burry's current bearish bets? He has been vocal about seeing disaster ahead. He has positions that would profit if the market crashes. He has drawn comparisons to 2008. Is he right? I genuinely do not know. He might be. He has been right before about things that everyone else missed. He sees patterns that others ignore. His analytical framework has proven to be extraordinarily valuable in the past. But I also know that he has made bearish calls before that did not pan out. He shorted Tesla multiple times, and Tesla kept going up. Being bearish is inherently difficult because markets have an upward bias over time. The economy grows. Corporate profits grow. Stock prices follow. Swimming against that tide requires exceptional timing. Here is what I do know. I am not positioned for a crash. My portfolio would decline significantly if the market dropped 50%, but I would also be fine. Berkshire has over $300 billion in cash and treasury bills. Our businesses would continue to operate and generate profits. We would have the resources to make opportunistic purchases when others were forced to sell. A crash would be painful in the short term but potentially beneficial in the long term, because it would create buying opportunities we have not seen in years. This is fundamentally different from Burry's approach, which is specifically designed to profit from a crash. He wins if the crash happens. He loses if it does not. I am more or less indifferent to whether it happens because my time horizon extends beyond any single market cycle. Let me tell you about another difference between our approaches that I think is important. I focus almost entirely on individual businesses. I try to understand their competitive advantages, their management teams, their capital allocation, their long-term earnings power. I do not spend much time thinking about macroeconomics, interest rates, inflation, or Federal Reserve policy. These things matter, of course, but they are essentially unpredictable. I cannot forecast what interest rates will be in 5 years. I cannot predict what inflation will do. I cannot know what policies the government will implement, so I ignore them. I focus on what I can understand and analyze, which is individual businesses. Burry, from what I can tell, incorporates much more macroeconomic thinking into his approach. His subprime trade was fundamentally a macro bet about the housing market and its impact on the financial system. His current bearish positioning seems to reflect views about monetary policy, debt levels, and systemic risks. He is trying to identify macro-level mispricings and position accordingly. Again, this is not wrong. It is just different. Some investors have made fortunes by correctly predicting macro developments. George Soros broke the Bank of England with a currency trade that was essentially a macro bet. But these trades require being right about extremely complex systems with countless variables. I have never been able to do it consistently, so I do not try. I want to share something that I think explains why both Burry and I have been successful, despite our different approaches. We both have extreme conviction in our own analysis, and we both have the psychological ability to act on that conviction even when everyone disagrees with us. This might be the single most important trait for investment success. The crowd is usually wrong at extremes. When everyone is euphoric, you should be cautious. When everyone is terrified, you should be greedy. But actually implementing this is extraordinarily difficult because it means going against the overwhelming consensus of people around you. It means buying when every headline is screaming disaster. It means selling or holding cash when every dinner party conversation is about how much money people are making in stocks. Burry did this in 2005 when he started shorting subprime. Everyone thought he was insane. The housing market was booming. Mortgages were being securitized and sold as safe investments. The entire financial establishment was telling him he was wrong. And he held firm because his analysis told him he was right. I have done the same thing repeatedly throughout my career. In 2008, when the financial system was collapsing, I wrote an op-ed in the New York Times saying I was buying American stocks. People thought I was either brave or stupid. But my analysis told me that great American businesses would survive and thrive. And I was right. This ability to maintain conviction in the face of overwhelming opposition is not something you can fake. You either have it or you do not, and it has to be grounded in genuine understanding, not just stubbornness. Burry could hold his subprime position through years of losses because he had done the work. He had read hundreds of mortgage prospectuses. He understood exactly why those mortgages would fail. That deep knowledge gave him the conviction to hold when everything was going against him. I can hold my positions through market crashes because I understand the businesses I own. I know that Coca-Cola will still be selling beverages in 50 years. I know that American Express will still be processing payments. That understanding gives me the conviction to hold when prices are falling. Let me talk about something that I think both Burry and I would agree on, and that is the importance of staying within your circle of competence. This is a concept that Charlie Munger and I developed over decades of investing together. The idea is simple. There are things you understand well and things you do not understand well. You should only invest in things you understand well. This seems obvious, but most investors violate this principle constantly. They buy stocks because someone recommended them, or because they read an article, or because the chart looked good. They have no real understanding of the underlying business, its competitive position, its management, or its long-term prospects. And then they are surprised when things do not work out. Burry stays within his circle of competence by focusing on areas where he has done deep research. He spent years studying the mortgage market before making his famous trade. He understood the mechanics of mortgage-backed securities, the incentives of the various players, the weaknesses in the rating agency models. He knew more about subprime mortgages than almost anyone on Wall Street. That knowledge was his edge. I stay within my circle of competence by focusing on businesses I can understand. I do not invest in biotech companies because I cannot evaluate whether a drug will pass clinical trials. I do not invest in complex technology businesses because I cannot assess their competitive advantages. I stick to businesses with simple, understandable models where I can reasonably forecast their future earnings. This limits my universe of potential investments, but it also limits my mistakes. Here is something interesting about circles of competence. They can be expanded with effort. When I started investing, I did not understand insurance companies. I thought they were too complex, too dependent on factors I could not predict. But over time, I studied them. I learned how to evaluate underwriting, how to think about float, how to assess management quality in insurance. Today, insurance is one of our largest business segments at Berkshire. My circle of competence expanded because I put in the work to understand something new. Burry has done the same thing. His circle of competence has expanded over time as he has studied new areas. His current interest in water rights and farmland reflects research he has done into long-term resource constraints. His technology investments reflect analysis of specific companies and industries. The point is that your circle of competence is not fixed, but you should only invest in areas where you have already done the work, not in areas where you plan to do the work someday. Let me address something that I think confuses many people about comparing different investment approaches. They look at recent performance and conclude that whoever has done best recently has the best approach. This is wrong. Investment strategies go through cycles. Some approaches work better in certain environments than others. Value investing, my preferred approach, has underperformed growth investing for much of the past decade. Does that mean value investing is wrong? I do not think so. I think it means that the environment has not been favorable for value. Interest rates were at zero, which inflated the value of long-duration assets like growth stocks. Momentum and passive investing pushed capital into already expensive names. The relative underperformance of value was partly a function of these environmental factors, not a fundamental flaw in the approach. Similarly, Burry's bearish positioning has cost him money during the recent bull market. Does that mean his approach is wrong? Not necessarily. It might mean that the environment has not yet been conducive to his thesis. If a crash comes, his approach will look brilliant. If the bull market continues indefinitely, his approach will look flawed. But we cannot evaluate an investment approach based on a single period. We need to look at full cycles, at how an approach performs through both bull and bear markets, through both favorable and unfavorable environments. I want to share my perspective on something that I think both Burry and I care deeply about, and that is intellectual honesty. This might be the most underrated quality in investing. Most people are not intellectually honest with themselves. They rationalize their mistakes. They take credit for their lucky wins. They remember their successes and forget their failures. They convince themselves that they knew things were going to happen after they already happened. This lack of intellectual honesty is fatal to long-term investment success because it prevents you from learning from your mistakes. If you cannot honestly acknowledge when you are wrong, you cannot figure out why you were wrong and how to avoid the same mistake in the future. I try to be brutally honest with myself about my performance. I acknowledge my mistakes publicly in my annual letters to shareholders. I have written about my failures in textile manufacturing, in airline investing, in various other areas. I do this not because I enjoy admitting failure, but because the process of acknowledging and analyzing mistakes is how I improve. Burry seems to share this commitment to intellectual honesty. He has been public about his losing trades. He has acknowledged when his timing was off. He does not pretend that every trade worked out. This honesty is rare and valuable. Let me conclude with some thoughts about what individual investors can learn from comparing Burry's approach to mine. First, understand that there is no single right way to invest. Different approaches work for different people in different circumstances. The key is to find an approach that matches your psychology, your time horizon, and your capabilities. Second, whatever approach you choose, commit to it fully. The worst thing you can do is switch approaches based on recent performance. If you are a value investor, stay a value investor even when growth is outperforming. If you are a macro trader, stay a macro trader even when the macro environment is confusing. Consistency is more important than optimization. Third, invest within your circle of competence. Only buy things you truly understand. If you cannot explain why a business will be more valuable in 10 years, you probably should not own it. Fourth, develop the psychological ability to maintain conviction in the face of adversity. This is hard. It requires genuine understanding of what you own and why you own it. But it is essential for long-term success. Fifth, be intellectually honest with yourself. Acknowledge your mistakes. Learn from them. Do not rationalize or make excuses. This is how you improve over time. The debate about whether Burry or I have the better approach misses the point entirely. We are playing different games with different rules. We have both found approaches that work for us given our skills, temperaments, and circumstances. The lesson is not to copy either of us blindly. The lesson is to understand yourself well enough to develop an approach that works for you. That might look like my approach. It might look like Burry's approach. It might look like something completely different. What matters is that it is authentic to who you are and that you can stick with it through both good times and bad. That is the real secret to investment success. Not finding the perfect approach, but finding your approach and having the discipline to follow it for decades. Two geniuses with two different portfolios can both succeed because markets are complex enough to reward multiple strategies. The market is not a puzzle with a single solution. It is an ecosystem with many niches. Burry has found his niche. I have found mine. Your job is to find yours. But let me go deeper into something that I think is crucial for understanding how these different approaches actually work in practice. The mechanics of how Burry and I construct our portfolios reveal fundamental differences in how we think about risk, return, and the passage of time. When I build a position, I am thinking about the next 20 or 30 years. I am asking myself questions like, will this company still be relevant in 2030? Will it have grown its earnings? Will it have returned capital to shareholders through dividends and buybacks? Will its competitive position have strengthened or weakened? These are long-term questions that require long-term thinking. The daily price movements are essentially irrelevant to my analysis. I do not care if Apple drops 10% tomorrow because I am not planning to sell Apple tomorrow. I am planning to hold Apple for decades. And over that time horizon, short-term fluctuations are just noise. Burry thinks about time very differently. Many of his trades have explicit time horizons built into them through the use of options and other derivatives. When you buy a put option, you are making a bet that a stock will decline by a certain amount before a certain date. If you are right, you make money. If you are wrong, Your option expires worthless, and you lose your entire investment in that position. This creates a completely different relationship with time. Every day that passes without your thesis playing out is a day closer to expiration. The pressure builds. The clock is ticking. This is not necessarily bad. It forces discipline. It prevents you from holding on to losing positions indefinitely. But it also means you cannot afford to be early the way I can afford to be early. If I buy a stock and it takes 5 years for the market to recognize its value, that is fine. I wait. If Burry buys an option and it takes 5 years for his thesis to play out, he has lost his money long before the thesis was proven correct. This difference in time orientation affects everything about how we think about position sizing and portfolio construction. I can afford to have concentrated positions because my time horizon gives me room for error. If I am wrong about Apple's next quarter earnings, it does not matter because I am not investing based on next quarter's earnings. I am investing based on the next 2 decades of earnings. Burry, by contrast, has to be more careful about position sizing because each trade has a specific time frame in which it must work. If he is too concentrated in a single bet and that bet does not work out within its time frame, he can suffer permanent impairment of capital. The famous subprime trade worked out, but it easily could have failed if the timing had been slightly different. He was nearly wiped out before being proven right. Let me share something about how I think about the businesses in my portfolio because this is fundamentally different from how Burry thinks about his positions. When I look at Coca-Cola, I do not see a stock. I see a business. I see bottling plants around the world. I see distribution networks. I see refrigerators in convenience stores from Bangkok to Buenos Aires. I see billions of people who drink Coca-Cola products every single day. I see a brand that has been built over more than a century and that has tremendous value in the minds of consumers. The stock price is just a number on a screen that fluctuates based on sentiment and flows. The underlying business is real and tangible and generates actual cash every single day. This perspective allows me to completely ignore stock price movements. When Coca-Cola's stock dropped during the 2008 financial crisis, I was not worried at all. People were still drinking Coca-Cola. The bottling plants were still operating. The cash was still flowing. The stock price was just reflecting temporary panic, not any change in the underlying business reality. I knew that eventually the stock price would reflect the business reality, and it did. I do not know exactly how Burry thinks about his positions, but my sense is that he thinks about them more as trades than as business partnerships. He is looking for mispricings that will correct. Once they correct, he moves on to the next opportunity. There is no intention of holding forever. There is no emotional attachment to the businesses. It is purely analytical. Again, this is not wrong. It is just different. Some of the most successful investors in history have approached markets this way, but it requires a different skill set and a different temperament than my approach. Let me tell you about something that happened during the 2008 financial crisis that illustrates these different approaches perfectly. When Lehman Brothers collapsed and the financial system was teetering, Burry's famous subprime trade finally paid off spectacularly. He had been waiting years for this moment. His analysis had been vindicated. The mortgages he had bet against were defaulting exactly as he predicted. He made hundreds of millions of dollars. At the same exact moment, I was losing money. My portfolio was down significantly. Berkshire's stock price had declined substantially. Every day brought more bad news, more write-offs, more pain. But I was not panicking. I was buying. I invested $5 billion in Goldman Sachs at terms that were extraordinarily favorable to Berkshire. I bought shares of General Electric. I wrote that up, it in the New York Times encouraging Americans to buy stocks. Why were Burry and I responding so differently to the same crisis? Because we had positioned ourselves differently before the crisis began. Burry had specifically positioned himself to profit from exactly this scenario. He saw it coming and structured trades that would pay off when it arrived. I had not positioned myself to profit from a crisis. I had positioned myself to profit from long-term business ownership. When the crisis hit, I had the resources and the temperament to buy at bargain prices, but I was not specifically betting on a crash. These are fundamentally different approaches to investing, and they both worked in 2008. Burry profited from the crash itself. I profited from buying great businesses at depressed prices during the crash. Both are valid responses to a crisis if you have positioned yourself appropriately beforehand. I want to talk about something that I think is important for understanding why both approaches can coexist successfully. And that is the concept of market efficiency, or rather, market inefficiency. Academic finance teaches that markets are efficient, that all available information is already reflected in prices, that you cannot beat the market consistently. Both Burry and I reject this premise completely. We both believe that markets are frequently irrational, that prices often diverge significantly from intrinsic value, and that careful analysis can identify these mispricings. Where we differ is in how we exploit these inefficiencies. I exploit them by buying undervalued assets and holding them until the market recognizes their value. Burry exploits them by constructing specific trades designed to profit when the market corrects its error. Both approaches assume that the market is wrong and that eventually it will be right. We just have different methods for profiting from this dynamic. The existence of market inefficiency is what makes investing interesting. If markets were perfectly efficient, there would be no point in analysis. You would simply buy an index fund and accept the market return. But markets are not perfectly efficient because they are composed of humans, and humans are emotional, irrational, and prone to hurting behavior. They panic at bottoms and get euphoric at tops. They extrapolate recent trends into the indefinite future. They confuse price movements with information. They follow the crowd even when the crowd is obviously wrong. These human tendencies create opportunities for investors like Burry and me who are willing to think independently and act on our analysis even when it contradicts the consensus. Let me share some thoughts about the current market environment and how I think about it differently than Burry seems to. He has been publicly bearish, expressing concerns about valuations, debt levels, and various risks he sees in the system. I do not share all of those concerns, though I do agree that the market is not cheap by historical standards. But my response to this situation is different than his. I am not making bearish bets. I am not buying put options. I am simply being more patient than usual. I am holding more cash than I typically would. I am waiting for opportunities that meet my criteria for value. If the market crashes, I will deploy that cash aggressively. If the market continues to rise, I will continue to wait. Either way, I am positioned to benefit over the long term. This is another fundamental difference between our approaches. Burry is making an active bet that things will go badly. He loses money. I am not making any bet about market direction. I am simply refusing to pay prices that do not offer adequate returns. If prices never become attractive again, I will have missed some gains, but I will not have lost money. The asymmetry is different. Burry's approach has more upside if his thesis is correct, but it also has more downside if his thesis is wrong. My approach has less dramatic upside, but also less downside. Over time, I believe my approach compounds more reliably because I am not taking risks of permanent capital impairment. I want to emphasize something that I think gets lost in these discussions about different investment approaches. The goal is not to pick the theoretically optimal approach. The goal is to build wealth over time while sleeping well at night. An approach that generates slightly higher returns but keeps you up at night worrying is not actually better than a slightly lower returning approach that lets you sleep soundly. Investing is a lifelong endeavor. You have to be able to sustain your approach through decades of bull markets and bear markets, through personal challenges and professional changes, through everything life throws at you. An approach you cannot sustain is worthless, no matter how good it looks on paper. I have found an approach I can sustain. It matches my temperament, my skills, and my goals. Burry has found an approach he can sustain. It matches his temperament, his skills, and his goals. Neither of us is trying to convert the other, because we both understand that what works for one person may not work for another. The diversity of approaches in the market is actually healthy. It creates the disagreements that make markets function. If everyone invested the same way, prices would become completely divorced from value. The fact that Burry is bearish while I am cautiously optimistic creates a more balanced market than if we all agreed. And when you do find your approach, have the courage to pursue it with conviction, the humility to learn from your mistakes, and the patience to let time validate your approach. That is what both Burry and I have done in our different ways. That is what every successful investor throughout history has done. And that is what you must do if you want to build lasting wealth in the stock market. The portfolios may look different. The time horizons may be different. The specific trades and positions may be completely opposite. But the underlying principles of independent thinking, thorough analysis, psychological discipline, and long-term commitment are universal. Master those principles, apply them in whatever way suits your nature, and you will succeed regardless of which specific approach you choose to follow.